good.
All right, Jeff, go ahead.
Well, Taylor, thanks for having me. Yeah, I don't know if we knew the topic until just the other day. So we're going to just kind of make this open-ended, and we can talk a little bit about fundraising, preparing for your first fundraise or any upcoming fundraise. So I'll give you a little intro on myself here. I'm a former founder, founded a company called Uppercase Living many years ago, sold that. And I'm also an angel investor and a startup advisor, pretty active angel investor as of late. And it's been kind of fun. I do a lot of Utah companies, and it's been a lot of fun. I also am on the advisory board for several startups right now, probably a few too many, but I love working with founders, love working with startups, and do a bunch of mentoring for some different organizations as well. So with that, here's kind of an agenda of what I wanted to cover today in preparing for your fundraise. And instead of just waiting till the end of this to answer questions, feel free. In fact, Taylor, if you want to monitor the chat room or wherever questions might come in, feel free to stop me, and we can take a side discussion or whatever we want to do there. So make this valuable for the group. But what I thought, this was kind of a brief agenda, and I call this, KYX, banking term, know your customer, KYC, probably heard of that. This is KYX in terms of preparing for a fundraise. And we'll go through know your investor, know your numbers, know your equity, know your pitch, and then put it all in one place. Make it easy for your investors. Earlier today, I was actually watching a recording from Sam Wong, who I know is a regular on the Midday Connect. And Sam brought out a statistic that said 75% of all pitches die in due diligence. And so what we want to do is make sure that before we get into that due diligence phase, that you are prepared and that your deal doesn't die in due diligence. And I think some of these things will help you to do that if you can kind of follow that pattern of knowing your everything, the KYX. So with that, let's start off. In fact, maybe let's just dive into know your investor. So this was something that I've definitely seen a lot of deals killed here. And these are deals that a lot of times shouldn't even be presented to investor. You shouldn't be wasting your time, and they shouldn't be wasting theirs, because there's no way they're going to invest in your company. An example would be, so if you've got a life sciences company or a biotech company and you're pitching to almost any of the well-known VCs here locally, you're probably not talking to the right folks. So you need to know your investor before you even set up a pitch with them or even suggest pitching to them. And there's a couple ways to do that. First off, one thing I would suggest going to LinkedIn and getting to know, if you're talking to XYZ venture capital firm or an angel investor, get to know who they are, who they've invested in. You can look them up on LinkedIn. Are there things that you have in common? Things like that. One of the things that I love to do, some of you are probably aware, I've done a lot of events where they're founders and funders events where we try and get founders and different investors together. I host a thing called Ski with a VC. Again, ways that you can connect with an investor and meet on a personal level rather than just pitching. But it's an easy way. If you can get to know your potential investors, you'll know right away if they invest in the types of companies that you have. The other thing to do is, look at their website and see, what companies they invest in. There's a lot of companies, and one thing to realize about investors is that they typically have restrictions on what they can invest in. So their money's coming from limited partners, and they have an obligation to invest the money for these other individuals or these big endowments. and they'll put restrictions on them. So you might have an LP agreement in there that says we only invest in, Delaware C Corps. That might be one of the criteria. So if you're not a Delaware C Corp, then you probably ought to think about things. But they may say that we focus on these specific sectors or companies at this stage. We're an early stage or we're a late stage. Typically, a venture capital firm, anyway, will have some pretty specific guidelines in terms of what they can and can't invest in. And so if you don't fit those criteria, it's better to know that up front than to go through a whole pitch and try and get in and spend a lot of man hours and time and energy trying to get into somebody that's not ultimately going to be able to invest in you. One thing to consider there is a lot of times when you look at private equity groups or angel groups, there's a lot more flexibility, or there can be. They still may have a thesis that you need to figure out if you fit into that thesis, but ultimately you want to find out if an investor is a good fit for you before you even pursue them as a potential investor. A lot of times you can look at their website, but you can also, a lot of times they'll publish their portfolio. Go through their portfolio and see what other companies they've invested in at what stage, and see if you kind of fit into that. If they've got a competitor, that might preclude you from being able to be considered there. So I'll pause here just for a second and see if any questions come in there, Taylor, or.
No questions yet. I just liked what you said about knowing your investor and getting to know them before you start pitching. I saw Earl Foote recently post about that, saying that his kind of rule of thumb or suggestion is when you meet someone new, don't try and sell them anything for the first 2 or 3 times that you talk to them. Just get to know them.
Love it. Yep. I think that's so critical. And, and I think along those lines, find ways to add value. I think both ways. I think sometimes founders come across as they're just looking for money. It's like, can you fund my company? Find ways to add value, even if it's to a potential investor. Do you know other founders that might be a good fit for them? And as you start to add more value, that's how you build relationships. So same thing applies to investors. Okay, the second thing is know your numbers. And again, this is another stumbling block I see for a lot of founders. This is actually one of the key things I see in the startup ecosystem, a challenge, and why one of the reasons I joined Forecaster, because this is kind of the problem they're tackling. But a lot of times founders don't know their numbers. And I don't know how many pitch decks I've seen where you always have the hockey stick graph. So that's their financials. And that's the extent of their financials, is they've got this hockey stick graph in there that says our revenue is going to go from, $10,000 to, $100,000 a month in this short period of time. And a lot of times the founders will make the mistake of doing a top-down model where they say, well, here's our TAM or our SOM, and we're going to take 1% of that. We're going to be really conservative and take 1% of this market. And that's a top-down approach, which when you get into the next phase of due diligence, that doesn't fly. You might be able to get past, get a meeting with a VC by having the hockey stick graph, but typically when you get into that next phase of due diligence, you need to know your numbers. What are the unit economics that you're dealing with? If you're saying that you're going to have $100,000 in sales by month X, how many customers is that? And what does that represent? Is it even realistic? And how are you going to get there? What are the revenue channels that make up that number? And what is the customer acquisition strategy? So all of those things need to be vetted out. And you typically do that through building a financial model from the bottom up. So if you take that bottoms up approach, you start with, what are your customer acquisition channels? And what does that look like? How many do you need, or how many are you going to have next month? and then the month after that, and start there and start to build that. And what does that mean for your revenue numbers? And then obviously you need to, factor in your costs, but ultimately this gets into what is the company's cash burn and how much money do you need to raise? And so that all kind of flows out of your, knowing your numbers. And trust me, a VC this will be something they definitely focus on, is how much money do you need and what's it going to be used for? If you don't have good answers for that, in a well put out, or well structured and organized financial model, it can throw up red flags. And I think on the flip side, it can add confidence to your investors if they see that you're really thoughtful and you've thought through all the numbers. So when we talk about preparing a financial model, again, this is going to tell you how much you should raise. And typically the benefit of having a financial model that you can kind of play around with is you can change the different assumptions and say, how does that impact things? And one of the line items you're going to definitely be looking at is kind of second one, how are you going to spend the money? And what is your cash burn going to look like? So, if you've got a scenario that says, well, what if our customer acquisition cost goes from, $3 to $5, what does that do to our cash burn? And if that's a realistic assumption that might have a variable like that, you need to know that if, let's say that you're going to raise $1 million, and then you run the scenario, and at a $5 acquisition cost, all of a sudden now you've got 6 months of runway based on this assumption. Well, maybe you need to raise more to build in a little bit more cushion there. Vice versa, let's say that you've changed some other assumptions that say we don't need to raise as much capital if these things happen. So maybe you want to tranche your investments and say, let's just raise this and see where we're at so we can get better assumptions. And that will strategically help us figure out how much money we should raise. So, I mean, there's so much value that you as a founder can have in preparing a financial model, but then you can use your financial model in sitting down with your investors or potential investors and run those scenarios with them. One thing that the investors will see is they'll see that, how you can work together with them. You're giving them a real live work, case where you're working side by side and they're saying, hey, what if we change this assumption to this? What happens there? And now you're going through it together, and it's not, your investor versus the financial model. It's us, the founder and the investor versus the financial model. What makes sense and what does this look like? How much money are we going to need? Again, it can be so valuable to have a good, solid financial model that you can go into the due diligence process with your investor on. Okay, I'll pause there. I saw there's a bunch of comments in the chat. I don't know if there's any questions or if they're just comments.
One question, Jeff, was from Casey about the best way to learn about previous investments from investors. Do you have any thoughts on that?
Well, a lot of times, venture capital firms will brag about their investments, and they love to show their portfolio companies. Most of them will list them on their website. So that's an easy way. I think going through their LinkedIn as well, you can see what companies they are talking about. You can ask other investors or other founders, that might know the VC, what companies they invest in. I think just asking around and looking at the website and then going to Crunchbase or PitchBook is going to give you a good idea of who they've invested in, how active they are. You're going to also want to, going back to that point in the investor due diligence, you're going to want to also know what stage their fund is in. So if they raised a fund, 2 years ago, and they're just thinking about now raising another fund, they might be out of deployable capital at that point. And that's a fair question to ask. Where are you guys at in terms of, your fundraising and the deployment of capital in your current fund? If they're at the tail end and they've got room for one more investment, that's good to know, as opposed to an investor that just closed a $75 million fund or a $150 million fund or whatever it is, and they've got a lot of fresh capital they need to deploy right away. So again, just the Crunchbase is a great resource for you to look at, some of that information.
Hey, could I make a suggestion there too? I think those
Absolutely.
are awesome. A lot of times, if an investor makes an investment, the company that they invest in will issue a press release. So if you Google the investor's name and press release, look for press releases, you can see, and not always, but sometimes they'll even include amounts, like what the investment amount was, or who else was syndicated with them in the investment in the press release. You can get a lot of information there too, to get some picture. Like, I don't know any funds that just like publish publicly, like, okay, we have this much dry powder, we're looking for 3 more deals. But you can kind of back into it with some of the publicly available info.
And that's a great point. A lot of times you can also see, if you do some digging, you can find it, whether it's a press release or some information about, this fund just closed their 4th fund and what date. And so you can kind of get an idea of where they're at in the life cycle of their fund. If you look at the venture capital funds, the typical life cycles, you're going to raise a bunch of capital, and you're under quite a bit of pressure to deploy that capital fairly quickly, because your investors want a good return on their investment. You typically have like a 10-year life cycle of the fund, and so you want to put that money to work as quickly as possible. And so, looking for a fund that has just raised, they've got a lot of fresh capital to deploy, and a lot of times you can find that again in press releases, or Crunchbase will tell you what, when their last fundraise was in a lot of cases as well. Great
Can I
comment.
add a little more to this, expand the question a little bit?
Yeah, go for it.
So I'm having a hard time putting together these two sides. One is get to know the investor personally, and the other one is to get to know the investment company.
Right.
By doing side work. How do you blend those two together so it doesn't come across as it seems a little awkward from my position to think how to go investigate somebody, but then befriend them, but not talk about the stuff that kind of needs to be talked about. I don't know. It seems I'm just trying to make sense of this in my head. It's new and cool.
I think, Casey, it's a great question. And I think that the befriending kind of goes back to your networking. Throw a wide net in your networking, and you'll be able to meet up with investors, and they may or may not be good, but you'll realize that just in talking to them casually and getting to know them, and what they invest in, what they do, what their interests are, that type of stuff. That's not going to necessarily be, that will be more opportunistic, I guess. But at the same time, if you're going to target your investors and really get into who is a good fit, that's where you're going to want to use Crunchbase. And then if there are opportunities where that particular firm would be a great fit, then see where they're at. Who are the partners there? Do you know anyone that knows somebody at that firm? Use LinkedIn and some other things like that to then hone in on who are some connections that I can make at this firm that has, a potential good fit for my company.
Okay, that makes sense.
Is that helpful?
Yeah, it's like smart, kind of like just being smart about your networking, but also expansive.
Yeah.
Okay.
Yeah. So, yeah, hopefully that's helpful.
Jeff, there was one more question from Maxwell in the chat about in the models, I think, Maxwell, the assumptions that you make and how you include those. Do you mind maybe unmuting yourself and giving some context around your question, Maxwell?
Yeah, Jeff said the models can change based on assumptions. And so I was curious if he has a framework for what type of assumptions should be there. Are they pie in the sky hopes and dreams? Are they like, I'm going to lose 2 people next month, so I have to account for that loss in talent?
Yeah, excellent question. So normally you're going to want to kind of do a best case scenario. Well, actually, I would probably start with a most likely case. Let's start with a most likely case scenario of what you think will probably happen. There's a good chance that these are the metrics that are going to happen. This is what our customer acquisition looks like. We're going to get this many customers this month from our partner channel, from our web spend. We're going to spend this much, and this is what we're expecting. So you'd go at it as a realistic case of what you're kind of thinking, best guess, and then do a best case scenario. It's like, okay, what happens if we blow things out of the water? Our customer acquisition cost is way lower than what we were thinking, or our acquisition rate is way higher than what we were anticipating. What does that look like? And what does that do to our cash burn or to our revenue? If it doesn't move the needle, then you're kind of thinking, oh, well, maybe we shouldn't be focusing on that metric and putting so much effort into driving this particular channel. But again, run some best case scenarios and kind of stress test your model. And then on the flip side, run a worst case. What happens if we don't get the traction we're thinking, or this metric is way lower than what we're hoping? What does that do to everything? Do you run out of money in 3 months because you change that assumption? What are the levers in your business? And it's really, the power of a financial model is you can make those assumptions and then have it go through the entire thing and see the impact on what happens 3, 6, 12 months down the road, without having to actually go through it. You can kind of project that out. And a lot of times you might have a metric that you think, oh man, what if our churn rate was 8% instead of 4%? What would that do? Would that kill our business, or are we still okay? And how much emphasis should we put on that? Well, you don't know that unless you run the scenarios and stress test it, because it's really hard to say, here's what the impact would be if this happened, unless you have a solid financial model that you can plug those assumptions into. So short answer, a best guess scenario, a worst case, and a best case scenario at the very minimum. And then you can just kind of tweak assumptions to kind of figure out the key drivers that really make an impact on your business. Does that help?
Definitely. I think the larger point is like showcasing to investors what could possibly happen, both the downside and the positive side, in order to come to someone who is ready to fight on your team and help you get to the best case scenario.
Yeah, absolutely. And I think the downside scenario, or I wouldn't call it a worst case, but let's say here's what happens under these circumstances. That helps your investor to have confidence in you as a founder, knowing that you've considered these things and that you're planning, against them. You're de-risking the investment for them. And it helps them to be able to kind of go, okay, well, what happens here? What would the cash needs be in these circumstances? And again, it just creates confidence in your investors as you can present that to them. So just to keep going, I know we'll run out of time here in a minute, but here's some resources. Like I said, I joined Forecaster in part to address this specific problem. Forecaster actually builds out the financial models for companies and puts it in a software that makes it really easy for founders to use and present to investors. And I'll give a quick shout out to the Startup Stack, where you can actually get a discount on Forecaster and a bunch of other tools out there as well. Okay, and I'll kind of skip through this as we're kind of low on time. But in my previous life, as many of you know, I was at Carta. This is, again, a key, knowing your equity is another key piece that you need to prepare for in the due diligence phases of the company. One of the first thing your investor is going to ask for is to see your cap table. make sure your cap table is up to date, accurate, clean. If you're using something like Carta, a platform, you can just share that with them. I think, again, that increases the confidence of investors to see that you're on top of things. The other thing I'll mention here is make sure you have a good startup attorney. I'm sure Jeff Holman would love me saying that, but a good startup attorney is worth its weight in gold. Use them even at the very beginning, at the formation of your company, to make sure you set things up correctly. And yeah, maybe they're kind of expensive sometimes, but a good startup attorney to put you on the right path is definitely worth it. And make sure startup is in that it's not that they have experience specifically working with startups, not just any attorney will do. So get your equity in order. Again, it's something, similar to a financial model. You can also, use the software like Carta and some others to be able to model out what happens to the dilution for you as founders under different scenarios. If we raise $2 million versus $4 million under these different terms, what does that do? Again, using tools that can help you assess these things is very helpful for you as a founder. And then again, just having everything in order creates confidence from your investors. Okay, so yeah, there's a bunch of red flags. This is probably a totally different, a total topic in and of itself of what investors look for in your cap table, but there's a lot they can see. It's not just the percentage of equity that you as a founder own, but which is important, but it's who's left the company, whether they exercise their stock options, how much you've got carved out for hiring needs for stock options and things like that. So again, make sure you're on top of things in terms of your cap table. Jeff, I know Taylor, I think we're going to run out of time here, but so I'll just skip over this. This is an easy one in terms of know your company, build a great pitch deck and present your company well, have that prepared. Shout out to Tim Cooley, who, if you need some help in building a great pitch deck, Tim was telling me just the other day that he's out there doing this for like $500. He'll help you build a pitch deck. So reach out to Tim. I hope I hope that I didn't lowball him on that, but that's what he told me.
$5,000 is what he said.
$5,000. Okay, $5,000.
I'm just kidding.
He told me $500. So tell him you get the Jeff Erickson discount if he asks. Anyways, Tim has some great. Tim's actually the author of the pitch deck book. I know he's a regular on here on the Midday Connect. Reach out to Tim even if you have some questions on building a great pitch deck. There's other resources out there. There's a company called pitchpages.io that makes it really easy to build a great pitch deck that you can share with investors. And then finally, I'll just wrap things up real quick and say, put everything in one place. Make it easy for your investors. So you've got your financial model in there, you've got your cap table, you've got your articles of incorporation, all your legal docs, your historical financials, your pitch deck, everything in one place in a data room. I don't know how regular they are on the Midday Connect, but there's a company called Savvy Legal. They have a great platform for building out a data room or a deal room. Highly recommend that. Carta has a deal room as well if you're using Carta. But make sure you put everything in one place where it's easy and accessible to your investors and very well organized. Again, this will streamline the process of due diligence, and hopefully you're not in that 75% of deals that get killed in the due diligence process. One thing I'll mention there is that the other thing that kills deals when you're going through due diligence is time. So if the investor is all excited to talk to you and they're like, hey, can you get me your financials and your cap table? And it takes you a month to get it. And you don't just have a link to say, oh, here's our deal deck and our data room. If it takes you that time, by then you may have lost interest, you've lost momentum. That kills more deals than anything, losing that momentum. So another plug to get things in order and make sure you're doing it. Here's a quick recap. Preparing for your fundraiser, research your investor, build a useful financial model, keep a clean cap table, create a great pitch deck, and then organize it all in one place in a data room. Okay, so I know we're up against time here. I am free to stick around if anybody else still has some time, and feel free to ask any additional questions.
Yeah, we can stick around until the top of the hour if there are more questions. But Jeff, thanks so much. This was fantastic. If are you willing or able to share this deck with the group?
Oh yeah.
Okay.
Yeah, absolutely. And here's my contact info as well for those
Perfect.
of you that don't have it already. But you can always connect with me on LinkedIn, shoot me a direct message, or there's my email address also.
Fantastic. I think if we wanted to dive in a little bit more on the forecaster side and kind of what the offerings are there, I saw something, Jeff, maybe the CEO of Forecaster has something this afternoon, a presentation. Is that right?
Yes, we do have, well, actually, I think it's on the 20th.
Oh.
The 20th, we have a financial modeling workshop. We have a lot of those that we do. And so that's something that, yeah, happy to share with the group. Trying to think of some, there's a whole bunch of them coming up. So happy to share those with you, Taylor, and you can distribute those to the group as needed.
Perfect. If you were to jump into that forecaster on the templates there, that link.
Oh yes,
Are
I totally
there
forgot about that.
Are there templates that you would suggest people start with first?
Okay, the interesting thing about financial modeling templates. So Forecaster provides free templates if you want to just use some of these. You kind of have to figure out what type of company and what type of model you're going to be using, right? So if you're a SaaS company, you're going to have certain metrics that kind of just fall into that. And so, I mean, you could download this one if you're a SaaS company. If you're more of a marketplace, you're going to have two sides of your financial model. And so it might be a little bit different template. So what they've done is they've created these, 10 different templates that you can use. And again, these are free. I think just go to forecaster.co/templates. And this gives you something to start with. If you get into this and you need some additional help, like I said, Forecaster has, financial analysts that will just build you a financial model with you. They'll hook up to your QuickBooks or whatever and pull in all that info and then help you create a well put together financial model that then you can run all the scenarios against. And it's in a software platform instead of the spreadsheets.
Cool. One of the other questions in the chat, Jeff, was around someone to help you do this work. I think Matt Shields had it saying, if you don't have a CFO, how do you find somebody who works well? Do you have any thoughts on that? Did I phrase that question right, Matt?
Yeah, I mean, just wondering, for early stage companies that are just technical founders at the earliest stage, they have no financial resources or expertise. Like, what do you see as the standard? Are they hiring somebody outside the firm that maybe is the best practice is usually just make a hockey stick model? Just wondering how you see them going about that today.
So again, this is the reason I joined Forecaster. Huge need in the market for this. You're at a stage where no, you can't afford a CFO. If you can, well, if you need a CFO in that level, then maybe you go to a fractional CFO group that works with startups that can build out a model. Typically, and I work with a lot of fractional CFOs. Typically, if you go to them, they'll build a model out for you, and it's probably going to cost you 6 to 10 grand is what I've seen. Some of them are more complex and they even get more expensive. But that's kind of the standard out there. Forecaster assigns you an analyst to work with you to build out a financial model. If you go through Startup Stack, or we could put together a deal with Midday Connect even, you can get a 25% discount. It ends up being $1,500 to build out a professional model. And then you've got support ongoing as you use that. But the cool thing is now, instead of having a spreadsheet that, you're going to break if you get into it and you mess up one of the cells and the formula disappears, you're now in a software platform that has some guardrails, makes it hard to break it, but then you've got the support to help you out as well ongoing. So it's an annual subscription, normally $2,000 a year, but it's $1,500 with the discount. And it is, you're getting a professionally built financial model as part of that. So
That's awesome, Jeff. One other thing that I've found, Matt, is we're working with a lot of students that, like MBA students. We've got one project going on with 2 or 3 MBA students right now that are building financial models for one of our companies. And that works well if you've got the time and to work with the students, but it's a great class project or capstone for many students that we've found, and they're super sharp.
yeah, that's a great idea. If you can leverage some of the students that might be able to do that. And Taylor, it might be helpful for some of those students to even use some of the financial model templates.
That's what
So
I'm thinking
feel free
as
to
well.
share that with them, and that will cut down on the time. I think that's one of the things if you can cut down on the time to get a good financial model. At Forecaster, it's usually 2 to 4 weeks to really build out a solid model that you can really use to work with, and so hopefully that kind of sets the stage there. On an ongoing basis, Forecaster is also offering fractional CFO work. So if you need more in-depth stuff going forward, you can also get fractional CFO work through that.
Very cool. We've been having a discussion about NDAs in the chat, Jeff. I think Jeff covered some of the answers for Brenda as well. So thanks, Jeff, for that.
Good.
Any other questions from the group, or Brenda, do you have any follow-up questions on the chat?
I have a question, Taylor. Jeff, so I mean, watching Shark Tank, you get the energy that happens in the Shark Tank room. Many times the investors are like, I couldn't stand to work with you. Like, you're just too crazy. You're all over the place. So, I mean, if everything is in line, they have the financials, the cap table, all that other stuff, how big of a portion do you actually look at the financials and look at the person, and look at the financials and look at the person and be like, even though you may not have everything correct, I could work with it.
Okay, so compare it to dating. If you were dating somebody you really didn't like, and then you asked them to marry you, how would that go? It's probably similar. So if you don't like your investors, you're signing up for a 10-year, I mean, if you're early stage, you're signing up for a 10-year relationship. And if you don't like each other, that could be really painful. And so, yeah, I would definitely, on your due diligence side, I would definitely, if they end up getting you a term sheet and you're like, you know what, I don't think I could stand to work with these guys, it's not worth it. There's plenty of great investors out there that will add value, that are great to work with. So yeah, Spencer, I would not go into any business. I mean, even if it's a co-founder or something like that, if you can't stand working with them, it's not worth taking their money. And plus, if they're irreputable, like if it's you just need the money and they're questionable integrity or something like that, they're going to show up on your cap table. So other investors down the road are going to see that. So, those are things to consider as well.
And if I can add that the dating analogy goes much farther than that. Don't be so desperate to cling on to the very first person that likes you, right? You don't have to marry the first person that smiles at you. Date, right? And make sure that, I mean, and oh my gosh, this analogy works so well. And I've seen it a lot on the investing side too. Don't go too far with your dating, right? You don't kiss every person on the first date, for crying out loud. You know, you get to know them first a little bit. And you go on a couple dates and, you know, that kind of a thing. And if it doesn't work out, don't cry in your Wheaties, for crying out loud. Go and get back out in the market and date a little bit more. It's better to take the time to find the right person than to just cling to the very first one that smiles to you.
It's interesting that we're putting this more on the entrepreneur side of it than on the investor, because the Shark Tank is reversed. Like everyone wants whoever they can get. Where here you're saying, you know, really date them out as an investor. And then if the entrepreneur or if the venture capital or the investor bites, then great.
In the long run, it's better for you if you look at it like that.
Well, and I wouldn't look at Shark Tank as the ultimate way to evaluate investors. And
yeah, no way.
That's very different. You don't want a shark. You don't want a shark as an investor, right? You want a partner. And you know, I see Brenda, you had some.
Yeah, I know. I keep thinking, because I think too, your question, Spencer, was about passion. And I think that your investor has to love your passion, whatever level that is. And an early mentor of mine said, I get really excited about my business sometimes. And I almost apologized. And he was like, Brenda, stop. Like, you better be obsessed with your business, or I'm not interested in working with you. So I think like there is a balance of like, there has to be a little bit of an obsession. There has to be passion, or that might not attract them to you. So I like being passionate.
I never thought the Midday Connect would be giving dating advice. This is awesome.
I know a few people that should have been here.
Can I make a comment on the dating thing?
Please.
My mom said, here are the 20 questions you're going to want to ask, or there's the test. You've heard these before. When you go to pick her up, does she reach through and unlock the door for you? There are tests. And so maybe there's just some simple business tests. My current business partner, when it became difficult, he became difficult. So I didn't know this about his character. Character comes out through difficult situations in any relationship, business or dating. So let's set up a few little simple tests, not just, did you comb your hair and brush your teeth today?
Yeah. I mean, honestly, I think one of the best things to get to know your investors, before you commit, outside of the boardroom, if possible. I know it's harder in the COVID era, and a lot of deals are made now just online, but I love about Ski with a VC. I mean, you're getting to know both sides. This is a dating thing from both sides, right? The investors need to know that you're somebody they want to work with, and you want to know that the investors are somebody you want to work with. And a lot of times you can kind of get that when you're doing things outside of the office.
Jeff, should you not take money from a VC who only skis black diamonds?
Yeah, don't take them skiing if you're not a good skier, and they are. That might not be a great thing, but
I was going to make one quick comment. Casey dropped off, but he was kind of asking, it's like, well, okay, how do you get to know an investor, build that relationship if they're looking for deal flow and you have a company, you're trying to raise money? And I think what I've seen that is good for that is the timing. Like, you don't want to meet the investor when you're like, in the thick of it. Like, start cultivating those relationships well in advance. Get an update email going. So because I think investors like to talk about investing, in my experience. Yeah. But it's the oh, I need $2 million and I need it by Friday or else I don't make payroll. Nobody wants to do that. It's right. Like, hey, do you want to be on my update list? Because I'm building something really exciting over here, and you're going to get a little tidbits of it as I grow over the next 6 months. And then when I come and say, hey, okay, I'm opening up this round, there's only a little bit for you, but I've reserved a spot. it's a whole different conversation than, oh, I need money right now,
Right, right. No, it's interesting. Yeah, that's a whole nother topic. We could do another Midday Connect
Done.
on just what to do after you go through the due diligence. This is we talked about the initial leading up, how you prepare for that due diligence process. What happens afterwards as you start to date in court? That the investor update is critical. I have so many companies that send me I get on their investor update emails. Some of them do a phenomenal job. Some of them do a terrible job. So again, that might be another topic down the road.
Yes, definitely. I accept, Jeff. We'll sign you up.
No, not me necessarily. Somebody else can handle that topic. So.
Well,
Awesome.
I'm going to jump off, folks. This has been very valuable. Thank you guys all very much.
Thanks,
Let's do
Harley.
it again next week.
Thanks, everybody. Appreciate it. We'll be here next week, so look for an email about topic. So I appreciate it. Jeff, if you want to send me the presentation, I can get it out to everybody.
Will do. All right. Thanks, everybody.